What's going on, everyone? So today I'm back at you again with another stock that I'm looking up. So I'm trying to add more dividend portfolio or dividend stocks to my portfolio just so I can build my bridge account and I can build a passive income.
For passive income. Passive income looks like this. You take money that you can afford to go to zero and you put them into two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate. And you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
So the requirements for my dividend paying stocks, let me know what your requirements, comment down below and like, subscribe to my video. What are my 3 requirements? Is number 1, it has to pay a dividend. No point being my dividend portfolio. Number 2 is it has to have good growth opportunity. And number 3, it has to be a good financial standing. Now, there's a bunch of different reasons why you can do dividend portfolio, but why I'm doing it is to build a passive income. Now, it might not be the best idea, might not be a worst idea, but I need to do something with my time. So I figure I'll go research another stock today. So the stock I'm looking at today is nothing fancy. It's just a very simple company, and they are called A.O. Smith. So the innovative for tomorrow, A.O. Smith is proud to be one of the world leading water heating treatment solution provider.
A.O. Smith is the second top pick on this day. AOS in New York. Brett?
Yeah, so A.O. Smith is water filtration. So, to caller's point earlier, so it's water filtration, it's boilers, and it's broadly water technology. When we look at tariffs and we look at what's going to impact the company, about 75% of their sales are domestic. So they're selling into the US. When we see that the devastation with these California wildfires, unfortunately, there's going to be a significant amount of rebuilding in that area. There's going to be a lot of demand for filtration technology, for boilers. And although they've had a few missteps in China and in India over the last little bit, the dividends continue to grow by about 12% per year. It's a high quality name, and it's something that I think is relatively cheap compared to historical rates, and something that could be added to the portfolio quite nicely.
Okay.
So I don't know much about them. I just found them. I Googled, hey, what's a good dividend paying stock? And this came up. So I haven't done my due diligence, haven't looked into it. But what do? It looks like they're a water treatment plant and they make water heaters. Let's see what brands they have. A.O. Smith water heaters. Okay, so they're in these brands right here. A.O. Smith, State Water Heater, Reliance Water Heater. So it looks like they're in a bunch of different water heaters. So there's not much I need to say about them, but watch this video of A.O. Smith and see who they are.
On providing innovative hot water solutions to plumbing wholesalers and contractors for residential and commercial application. That focus has continued for more than 70 years now.
To the stock. So yes, I can go more in detail, but I want to see what this stock is doing, and before I get into much detail. So I want to see what's the growth potential. Have they been doing well or have they not doing? So I like to look at the chart. So year to date, it's negative 7.54. 1 year is a negative 25.11. 3 years is 9.96. And 5 years, 33.37. Now that does not look that good for a stock growth. It looks like they're kind of, best way to put it, evened out. They haven't been really growing very much. If I do the max, they're up 6,000%, but that's the max since they've been for 150 years. Well, in business for 150 years. Now, I do like to compare A.O. Smith, AOS dividend history. So they pay a dividend yield of 2.1% or $1.34. And let's go to stock analysis to see what they are doing. So it says it paid 2.15%, pretty good dividend. They have a dividend growth of 6.35% with the growth years of 32 years. That's pretty good. It's been growing its dividend for 32 years now. Pretty stable. Now, I do like to look at the finance, and if you don't know what something is, comment down below if you don't. But I like to use MSN Finances because it's easier for me. And if I don't know what something is, I go to the side and says, see what it's like revenue. Investor measure growth by how fast a company revenue sale is growing year over year. So it tells me right there. So let me see, am I right if I about this company? So from 2017 to 2024, how much did the company grow? So 3 billion, 3.19 billion, 2.99 billion, 2.9 billion in 2020, which is the COVID year, 2021, 3.5, 3.7, 3.8, and 3.8 billion. So I am correct when I said it looked like it evened out. So I don't expect much growth. Financially, they might be in good standing, but they don't look like they're growing financially. It looks like they just kind of stagnate at 3.8 billion. Now, the other thing I like to look at is gross margin. What is gross margin? Example, gross margin is percentage of revenue minus cost of goods sold, shown as percentage of revenue. Higher gross margin is better. So 38.14, not bad gross margin. Now the other thing I like to look at is net profit. Net profit shows how much each dollar of revenue translates into profit, shown as percentage of revenue. Higher is better. So 13.98%. They have a great profit margin. So financially, this company is stable based off these numbers. They're not growing, but they're not really dying. And just to check what's going on financially, we can go into the cash flow and see what the cash flow doing. See if it's stabled out, they're spending more money. So operating cash is 581 million and free cash flow is 473 million. Yes, they have a pretty good cash reserve. It looks like they stay between 597 million to 473 million, which is pretty good. So let's look at the balance sheet. I'd like to look at the fixed asset and current assets and see if it's more than the current liability and long-term debt. So I like to do this to see if they owe more money and or are liable more than what they own or have on asset. And it looks like they're in 1 billion, 1.7 billion in liabilities, and they have fixed asset of 1.85 billion. So they're in the positive about 1.4 billion. So it's not bad. This company book value should be about $1.4 billion according to this. Now, I'm not including anything else, but this is, if you really don't know what something is, this is why I like using MSN, because right on the side of it, it tells you. Now, if we go into the company, let's see who sold. So Carnivair's Samuel sold, and he's the senior vice president of global. And James, I don't see James. It might be on here, but I don't see him. So those two sold. It's a good or bad news if they sold. If I see everyone here is just sold, I tend to not buy the company just because I don't trust it. But you got a good split. Some people hold it, some people sell it. And that's just something I like to look at. Now, I also like to look at who invests in this company. See if it's a good potential to buy by who is buying. So the top buyer, I like to see something like BlackRock's, State Street, some of the big companies. Let's see. Well, State Street is a top seller. That means I probably won't buy it because I see State Street selling it. I don't see BlackRock or any of the new or big companies or investment company in this. So I probably won't buy this just because I don't see a good reason to. So I like to also use AI to summarize everything to see what I am looking at. So AI could mean a lot of different things. It could be wrong, it could be right. It's based off all the information. So evaluation is 3 out of 6. Yeah, I think they're a good, stable company. Earning is 4 out of 6. They do make pretty good money. It's just I'm looking for stock growth. I'm not getting in that money. It's based off growth in dividend. Future growth, 2 out of 6. I agree with this 100%. They don't look like they have a good growth opportunity. Historical performance, yes, if you do it for 150 years, they're doing awesome. But if you do it in the last 5 years, 2 years, 3 years, they're not doing that great. And financial health, I think they're doing pretty good. They have about 1 year worth of reservoir of cash so they can keep operation, but that's pretty much it for them. So the earning for PE ratio compared to their industry, they're doing better than their peer average, which is good. Now, the analysts recommend to buy. Now, this is the time I'm going to tell you I disagree with the analysts. And here's why I disagree with the analysts. Based off the finance here is I don't see no more growth here. So if they have no growth financially, I don't expect the company to have a growth in their stock price because it's based off this. It's supposed to be based off how much a company makes, how much they're earning, and their total assets. You're trying to own a piece of a business, and this is where people get misled. This is you owning a part of a business, and based off this information I have, I don't see growth potential. Now let's talk about this. A.O. Smith, their water heater company. They look like they're a good, stable, blue chip company. If you're looking to just have a nice, steady growth of a company, this should get you a nice 6 to 7%, year over year. So if you have the company for 3 years, I do expect you to get a 6% every year. So you might get an 18% growth in the long term of this stock. Now, they do pay a dividend of $1.36 dividend per share or 2.15% overall. And they have a good dividend growth history. So why am I not going to buy it? Well, because I don't see a good growth opportunity for this company. The stock isn't growing. And if I wanted to add this to something, it would more be like a retirement account, not a account where I am trying to build a dividend growth portfolio. So it is a good company. If you're trying to buy something for a blue chip company, great blue chip company. But for the standard of good growth for the next 10 years, I don't see it growing that much. And based off the finance of it only being at 3.8 billion for the last 3 years, 4 years, they're not growing. So I don't see the value of the company going up. And this is the reason why I'm not going to purchase it. It's not because it's not a good stock. I'm not purchasing it because the growth opportunity don't look like it will be there. The finance looks good. It does pay a dividend, but it doesn't meet my growth opportunity. And unless there's going to be a major boom where a lot of water heaters are going to be needed, I just don't see the growth for this company. So like and subscribe to my video, and that's all I got for you.